Okay, let's dive in.
Let's do it.
We're tackling a topic today that, well, it comes up constantly in the news, doesn't it?
All the time.
The U.S. national debt. It probably feels pretty abstract to most people, I think.
Yeah, it's this massive number that just keeps climbing.
And everyone seems to have an opinion.
Mm.
Is it a crisis waiting to happen or, something else?
It's definitely complex. Our goal here really is to try and cut through some of that noise.
Right.
We want to unpack what this debt actually is, why it acts the way it does, and maybe why it's so difficult to manage.
Sort of give you the essential map for navigating this whole thing.
Exactly. We'll look at the sheer size, what it's actually used for,
What the real worries are.
and maybe clear up a few common misunderstandings along the way.
Okay, let's unpack this. Where do we start? That big number.
Yeah, let's start there. The headline figure is, well, it's staggering. As of early September 2023, it was nearly $33 trillion.
Wow. Yeah, that's a number so big it almost loses meaning.
It really does. Hard to visualize.
And it's interesting how it breaks down because it's not all like owed to China, right? That's a common misconception.
Not at all. A pretty significant chunk, maybe $7 trillion or so around late July 2023, is what's called intra-governmental holdings.
Okay, what does that mean exactly? Intragovernmental.
It's basically money the government owes to itself. Think of trust funds like Social Security or Medicare.
Ah, so it's like moving money from one government pocket to another. An accounting thing?
Pretty much. It's different from debt held by the public because it's internal.
Okay.
The vast majority, though, about $25.7 trillion, that is held by the public.
And the public here means?
Individuals, companies, state and local governments, pension funds, and foreign governments and investors too, anyone who bought U.S. Treasury securities.
So that $25.7 trillion is the money borrowed from outside the federal government itself.
Exactly. And the way the debt itself is defined in the material we looked at is, well, it's interesting.
How so?
It's called nothing more than an accounting record.
An accounting record. That sounds like less scary than massive debt.
Well, it frames it differently. It's essentially a running tally. All the dollars the government has added to the economy through spending, minus the dollars it's taken out, mostly via taxes.
Huh. So it's a historical record of net government spending.
In a sense, yes. And a really crucial point made is that aiming for zero debt isn't necessarily the goal. It might not even be desirable.
Okay, that definitely goes against how we think about our own household debt. Why wouldn't zero debt be good?
Because the debt actually serves important purposes. It's a tool.
Like what kind of purposes?
Well, think about big emergencies, the pandemic, for instance, or the global financial crisis back in 08, 09.
Right, government spending shot up then.
Exactly. And the debt increased significantly because borrowing is often the fastest way to get those funds out there during a crisis.
Faster than trying to raise taxes massively overnight, I guess.
Much faster and less disruptive to the economy at that moment. So crisis response is one key use.
Okay, what else?
Smoothing out economic shocks. It gives the government flexibility.
How does that work?
It allows for counter-cyclical spending. So during an economic downturn, tax revenues naturally fall, right?
People earn less, companies make less profit.
Right. But that's often when the economy needs a boost. Borrowing allows the government to maintain or even increase spending then, helping to stabilize things.
And maybe spend less or pay down debt when the economy is booming.
Ideally, yes, that's the theory. It acts as a stabilizer.
Got it. And how does the government actually borrow this money? It's not like they go to a bank for a $25 trillion loan.
No, definitely not. They issue securities, treasury bonds, notes, and bills. You've probably heard of those.
Yeah, T-bills, bonds.
Right. They're basically just IOUs. Formal promises from the government to pay back the amount borrowed, the principal, by a certain date.
And they usually pay interest along the way.
Often, yes. Especially for notes and bonds, they make periodic interest payments.
So who's buying all these trillions in treasuries? Why are they so popular?
It's a huge range of buyers. Individuals, banks, pension funds, insurance companies, state governments, and yes, foreign central banks and investors.
And the attraction is?
Safety. Primarily safety.
Right.
U.S. government debt is widely considered one of the safest assets in the world.
Why is that?
Well, the U.S. government has never defaulted on its debt, and the U.S. dollar is the world's main reserve currency. So if you're a large institution or country looking for a secure place to put massive amounts of cash,
U.S. treasuries are the go-to.
they really are. There's a deep liquid market for them.
Okay, so debt isn't inherently evil. It has uses, and people want to lend the U.S. money because it's safe.
Well,
But that $33 trillion number still sounds scary. The concerns are real too, right?
oh, absolutely. The analysis makes a clear distinction. Borrowing for genuine emergencies or, say, long-term productive investments like infrastructure, that can be justifiable, even beneficial.
Yeah.
But borrowing heavily just to fund ongoing consumption year after year, especially during good economic times, without matching revenues, that's seen differently. That's described as potentially deteriorating the financial or fiscal future. It's borrowing for today's spending without a plan for tomorrow.
So it really matters what the debt is funding.
That's a key argument. And then there's the question of how much debt is too much.
Yeah, how do we even gauge that?
The crucial metric here is the debt to GDP ratio.
Right, you hear that talked about a lot. That's the total debt compared to the size of the entire U.S. economy in a year.
Exactly. GDP, gross domestic product, is the value of all goods and services produced. So the ratio tells you how big the debt is relative to the economy that supports it.
And where does the U.S. stand?
Currently, it's close to 100%, meaning the public debt is almost as large as the entire annual economic output.
Is that bad? Is there a magic number?
Well, the material mentions a kind of stability number, sometimes cited for an economy like the U.S., maybe closer to 70%. But it's debated.
Okay.
The real importance of the ratio is what it suggests about a country's ability to service the debt.
Meaning, make the payments. Principal and interest.
Precisely. Can the economy generate enough activity and tax revenue to comfortably handle its debt obligations without straining other priorities?
And that brings us to the cost of the debt. The interest payments. That's a huge line item itself, isn't it?
It's becoming a very significant one.
Yeah.
As the total debt grows, obviously, the interest owed grows too, but it's compounded when interest rates go up.
Which they have been quite a lot since the Fed started raising rates in March 2022.
Exactly. That makes borrowing more expensive for everyone, including the government on its new debt and sometimes on existing variable rate debt.
So those interest payments are climbing fast.
Dramatically. In 2022, the U.S. government paid something like $475 billion just in net interest.
Wow. $475 billion just on interest.
Yeah. That was nearly 2% of the entire GDP just servicing past debt.
That's a lot of money that could potentially go elsewhere.
It is, and there's an interesting dynamic pointed out. Higher interest rates mean the government pays more, but that money goes somewhere. It funnels hundreds and hundreds of billions of dollars in additional income to bondholders.
Ah. So the people and institutions holding the U.S. debt, they're actually earning more income because of the higher rates.
That's the flip side of it, yes.
Okay, this brings up something you mentioned earlier, the confusion around comparing government debt to household debt. You said that's a big misunderstanding.
It really is highlighted as maybe the biggest point of confusion. People naturally think, well, if I took on too much debt, I'd go bankrupt. So the government must be heading for bankruptcy too.
Yeah, that fear feels intuitive.
Yeah.
The government needs to tighten its belt like a family.
And the analysis is very clear on this point. That analogy is simply not true.
Why not? How is it different?
A sovereign government that issues its own currency, like the U.S. with the dollar, operates under fundamentally different rules than a household or even a business.
It can essentially create money to pay bills denominated in its own currency.
In simplistic terms, yes, although it's more complex involving the Federal Reserve. But the core point is it doesn't face the same kind of insolvency risk as a household that uses the currency but doesn't issue it. The fear of the U.S. government being unable to pay its dollar-denominated bills like a household is seen as unfounded.
Okay, that's a really important distinction. So that common comparison just doesn't hold water.
Not according to this perspective, no.
Are other countries dealing with high debt levels like the U.S.? Or are we an outlier?
Oh, definitely not unique. There are about 15 other countries with even higher debt to GDP ratios.
Really? Who's at the top?
Japan has the largest ratio, by quite a margin, actually.
Japan. And they're brought up as a kind of case study, aren't they?
Yes, because their experience is interesting. They've had extremely high debt, well over 200% of GDP for a while now.
How has it happened? Have the predictions of doom come true?
Well, that's the thing. For decades, mainstream economists predicted that Japan's massive debt would inevitably lead to disaster runaway inflation, soaring interest rates, a fiscal crisis.
Oh.
But it hasn't happened. Over 3 decades of large deficits, those specific dire consequences haven't materialized in the way predicted. Interest rates have remained incredibly low, and inflation wasn't really an issue until very recently, globally.
So Japan's situation seems to challenge the idea that there's a simple fixed limit to how much debt a country like that can handle.
It certainly complicates the narrative. It suggests factors like who holds the debt, the currency status, and domestic savings might matter a lot.
But there's a counter-argument mentioned,
Jamie?
too.
Yes, the counterfactual argument.
Hmm.
We don't know how Japan's economy would have performed without all that debt.
Meaning maybe it could have grown much faster.
Possibly. Maybe the debt acted as a drag in ways that aren't immediately obvious, like misallocated resources or crowding out private investment. We can't know for sure what didn't happen, so it remains a complex example.
Okay, shifting gears a bit. There's a uniquely American aspect to all this that causes drama. The debt ceiling.
Ah, yes, the debt ceiling. Described pretty bluntly as a self-imposed constraint.
Let's clarify. A default means the government actually fails to make a payment it owes, right? Like missing an interest payment on a bond.
Correct. A failure to meet a legal obligation. The debt ceiling is different. It's a legal limit set by Congress on the total amount the U.S. government is allowed to borrow.
Even if Congress has already passed laws that require spending that necessitates more borrowing.
That's the core conflict. Congress approves spending bills and sets tax policy, which effectively determines the need for borrowing. Then separately, it restricts the Treasury's ability to actually do that borrowing once the preset limit is reached.
That's illogical.
Many analysts view it that way. The U.S. is almost unique in having this setup. Denmark apparently has one, but they set it so high it never becomes an issue.
So it puts the president and the Treasury in a bind. They're legally required to spend money, but legally blocked from borrowing to do it.
Exactly. It creates these standoffs where the executive branch has conflicting legal mandates. And the view presented is that it's totally unnecessary because the crucial decisions about spending and taxes have already been made by Congress.
It's like arguing about paying the credit card bill after you've already made all the purchases.
That's a common analogy used. And these fights aren't just political theater, they have real consequences.
We saw that recently, didn't we?
You did. In August 2023, Fitch, one of the big credit rating agencies.
Right. They rate the creditworthiness of countries and companies.
They actually lowered the U.S. credit rating from the top AAA level.
And the debt ceiling fight was a major reason.
A key reason. Fitch cited three main factors: the expectation that the U.S. debt-to-GDP ratio will keep rising, the lack of a clear plan to address these fiscal challenges, and this is crucial, the terrible governance demonstrated by the repeated debt limit brinkmanship.
So the political dysfunction itself hurt the U.S.'s financial reputation.
Precisely. It signals instability and questions the reliability of U.S. policymaking.
That Fitch downgrade must send ripples internationally, especially considering how much U.S. debt is held overseas.
It certainly doesn't help confidence. As we mentioned, foreign entities hold a lot of U.S. debt, around $7.4 trillion at the end of 2022, which was about 30% of publicly held debt then.
Is there a risk associated with that? What's the concern?
The potential concern is something like a run on the bank, but playing out on an international level with U.S. treasuries. Meaning, if foreign holders, especially large ones like other countries' central banks, were to lose confidence that U.S. debt is still the ultimate safe asset.
They might start selling their holdings.
Exactly. If they worry about U.S. political instability, its long-term ability to manage its finances, or maybe even the future value of the dollar, they could decide to reduce their exposure to U.S. treasuries.
And what could trigger that kind of loss of confidence?
Well, things like the Fitch downgrade are signals. Continued political gridlock over the budget and debt, a constantly rising debt-to-GDP ratio with no stabilization plan, maybe sharply higher interest rates making the debt burden look unsustainable. Any of these could make foreign investors nervous.
A large sell-off could presumably cause problems, like driving up U.S. interest rates even further.
Potentially, yes. It could disrupt financial markets if it happens suddenly or on a large scale. It's a vulnerability that comes with being so reliant on foreign financing.
Okay, so considering all this, the scale, the interest costs, the political dysfunction around the debt ceiling, these international risks, what's the bottom line? Is the U.S. national debt actually going to get paid off?
The conclusion drawn from the materials is pretty stark. The debt isn't getting paid off anytime soon.
Not anytime soon. And the main roadblock seems to be politics.
It really boils down to that. There's this political paradox.
Which is?
In opinion polls, people generally say they favor reducing the deficit. They like the idea at the abstract level. But when you propose specific ways to do it, like cutting popular spending programs, whether it's defense or social programs, or raising taxes that would affect them directly,
that support vanishes pretty quickly.